Hi everyone here. So as Brooke mentioned, I'm going to be speaking about our NextEdge Private Lending Fund. I think it's fairly topical in the sense that after a week like last week, our fund had essentially no volatility or movement to its price, other than maybe a little bit of accrued interest. Prior to kind of focusing a little bit on what we're doing in the fund, I thought I'd give a little background as far as some of the opportunity in the private lending space. Some of it fairly basic, and some we look at this space quite differently than most people. As far as why the attraction to private lending in the first place, anytime that there is a relative opportunity out there, I think people start looking at things. Within the traditional fixed income space, interest rates are very low. A lot of investors are unhappy getting maybe 1 or 2 or 3% from that part of their portfolio, and have started looking for alternative ways in order to make a return. Private lending and alternative yield products are definitely one of them, and there's been a fair bit of money moving to that space because of the return opportunity. In general, what we've seen over the last 5-8 years as a lot of private lending funds have come about, most of them are kind of seeing kind of long-term equity-like returns with debt-like characteristics, so that's very attractive as an investor. From the fact that I've probably looked at 50 to 100 different private lending managers throughout North America and parts of the world as far as investment opportunities for ourselves, I would say first and foremost, most of these managers' focus is on capital preservation. I think from an investor standpoint, that resonates quite well. As far as low correlation and consistency of returns, the low correlation part I think is a little bit oversold. The fact is that these private lending funds don't have to deal with market sentiment pricing. Typically a lot of these loans are held at par unless there's an impairment to it, so you are going to tend to have low correlation just because they don't price. So it's not necessarily fair to compare them to equities or traded fixed income as far as a correlation statistic, yet they do have low correlation. Consistency of returns, though, is obviously something that a lot of people find very attractive. One thing that we spend a fair bit of time trying to explain to investors, if we had more than, say, 10 minutes today, is really what we're trying to capture. What's been embedded in my brain over the last, say, 28 years in the financial business is typically if you're attaining a higher return, you have to take more risk in order to get it. We feel, and I've spent the last 20 plus years focused on hedge funds and alternative investments, and a big part of our focus is trying to find areas where there's inefficiencies where you can capture that excess return without really taking much more risk. We think what we're doing within this fund is trying to pick up a whole bunch of inefficiencies or kind of yield premiums. I've kind of listed a few there. One is that whole macro environment as far as the banks reducing their allocation to a lot of lending. That started happening before 0809, by the way, but definitely accelerated since then in certain areas. Illiquidity risk, there's definitely a premium that could be had for size of a transaction. I know that a $5 million ABL transaction whereby maybe we can put out a yield at 12%, that same loan with the same LTVs on the same assets on a $50 million size transaction, you're getting 8 or 9%. Size is a key, and it's a way to pick up premium. A whole bunch of other inefficiencies such as price discovery. It's very inefficient for companies that are trying to find, when they realize they can't get a bank financing, for them to kind of find who actually to go to get a loan from. Very inefficient and creates some price discrepancy out there and yield premium. The focus of our fund, and what we're trying to do is we're focused on kind of loan sizes in that $1 to $25 million marketplace. We're doing that to partially capture that size premium, and partially because we feel that market's fairly inefficient from a service point of view, as well from the fact that most of the players are very regional focused, not kind of North American wide. What is it that the NextEdge Private Debt Fund is? It's an open-ended offering memorandum, kind of evergreen vehicle that currently it's about $400 million of capital deployed throughout North America. It was started almost just under 5 years ago, and it's focused on lending to businesses throughout North America, with the focus on the on factoring, which is kind of the purchase of receivables as a means of financing businesses. It's focused on asset-based lending to businesses, as well as to specialty finance, which is a kind of a form of asset-based lending, whereby we're lending to actually other lending companies. Portfolio is vastly diversified, has 173 different positions, 161 unique clients. 126 of them are factoring clients or facilities, 35 asset-based loans, 12 specialty finance transactions. And when I say vastly diversified, not just by numbers, but by regions as well. Currently, we have clients or transactions or loans out in 32 different states and 6 different provinces throughout North America. So vast scope as far as our origination efforts. Currently, the portfolio is about 55% allocated to the U.S. and 45% in Canada. We tend to try and have a yield bogey as far as what we're trying to get as far as a minimum yield from our transactions in our portfolio. Currently, the gross yield in the portfolio is about 12.3%. From that, you would take off our management fee, performance fee, and some operating expenses, and it's kind of how we kind of control our minimum return hurdle to our clients, which is kind of in that 8 to 10 barrier. We have a vastly experienced credit team, so we've partnered with a credit shop that's been around for 21 years. Of our 8-9 senior members of our credit team, I believe 7 of them have in excess of 20 years of private lending experience. It's a very, very experienced team we've been able to assemble based throughout North America. In addition to that, and we think that just as important as credit underwriting is origination efforts, we have originators placed throughout Canada as well as North America. We think access to actually finding these transactions in the first place is just as important as doing the proper underwriting. Your underwriting is going to be only as good as the deals you're able to try and work on in the first place. So we put a lot of time, effort, and a significant amount of capital towards that. Very quickly, I mentioned that these are the 3 areas that we focus on within the fund. Factoring is really just the purchase of receivables as a means of financing a business. We're not giving a loan to the business in this case. What we're doing is we're looking at their end debtors, the receivables, which is an asset on their books, and essentially it's a purchase and sale agreement. We're buying those assets, taking legal title of those assets, making sure that those receivables are real, that the goods and services that were delivered are in good standing, that their intention is to pay. Then once we do that, we take legal title of them and they have to pay us. On average, we're lending between, say, 79 to 90% on the dollar, getting them credit insured, as well as taking personal and corporate guarantees on those businesses that we're buying the receivables from. Asset-based lending is literally a loan to a business. On average, our typical term is a 1-year demand facility. And what we're doing, in addition to looking at the health of the business, which is somewhat important in the sense that we want to make sure the company's around, in a few years, but very important and key and parcel to everything we do here, there has to be an asset backing that transaction. So we will lend against things like receivables. In an asset-based lending transaction, we're not buying the receivable, we're just lending against the value of them. Inventory, real estate and equipment. The last 3 we're getting independently appraised on a net orderly liquidation value on the inventory and real estate, and a forced liquidation value on the equipment. The specialty finance lending is really just a form of asset-based lending. In this case, we're just lending to other lenders, such as, in North Carolina, there's a fairly significant factoring business that's been around for quite a while. We actually lend to them based on the value of their factoring book. That's kind of a quick summary of what we do. How have we been able to perform? Our target is in that 8 to 10% net return basis. On our, kind of institutional or fee-based class, we've done around 9 over the last 4.5 years. We know that there are some other funds that have done a little better than that. One thing that I would say is that our loans are almost all in a first, senior secured first position basis, and that all of our loans are asset-backed, collateral-backed, so it does make a little bit of a bearing. With that, I'll wrap it up and take any questions.
Great, thanks, Rob. I'll take the first question.
Sure.
That's my job. So, as you mentioned, I find private.
We've known each other for a long time, by the way, Craig.
We have been. We've talked about this a great deal. Private lending is becoming a really prolific asset class. It's, there's many foreign funds coming to Canada. There's huge amounts of money flowing in the U.S., whether it's the big private equity guys and different funds and so on and so forth. It's in my mind, it's a really good space to be. Can you talk about, however, it's a great place to be, but there's often some misconception and some misconstrued sort of ideas around getting into this space. So can you speak a little bit about the notion of perceived risks in terms of rates rising and why people go to you rather than to the traditional bank world?
Yeah. I think the first thing that people need, one comment that's obviously come up to me, Craig, quite a bit over the years is how there's quite a few private lending funds that are all kind of seem like they're returning in the same range. And how do I differentiate one private lending manager from another? And, to me, it's really understanding how they're getting that return. What are they offering to their clients? Why are they offering, if everyone's returning 8% and the manager's clipping a little bit of a fee and a performance fee, you're probably putting out loans at 11, 12% plus. How is it that they can do that? Where is the risk in that transaction? Are they actually in the senior part of the stack? Are they senior secured or junior unsecured? Are they collateral or non-collateralized? I think the big risk in what these people are doing is really the types of transactions that they're doing and where they are in the capital stack. Are they taking pref or are they senior secured? That I think is fairly important. There has been a lot of money moving into the space, over the last, say, 3-4 years. I get a little concerned about that. We think we're kind of staying under the radar a little bit in our under $25 million size bracket, and most of the big money is really not competing or even touching most of what we're doing, so we're fairly cognizant of that. But there is yield compression out there, even in our space somewhat. There's a vastly more yield compression in the larger space, whereby they're getting a little bit more aggressive and that sort of thing. So I don't know if that totally answers your question, but it kind of hits on kind of what I think people should look at as far as.
Yeah, it seems to me that you guys are just more flexible in terms of your ability to lend and work with your borrowers. The banks are getting more constricted. You talk about that. You've got flexibility. You can be flexible in terms, all that kind of stuff.
Flexibility up to a point, Craig. At the end of the day, we want to get our money back just as much as a bank does. We might be a little bit more entrepreneurial as far as, okay, if we can't get the same 2 check boxes as the bank's looking for, what else can we get somewhere else? Can we get a second on the person's house and cottage? Where else can we get collateral to be comfortable? Can we put some other covenants in, to make sure that they're fully aligned with us? So it's not like we don't necessarily want to get the money back as bad as anyone else or the bank. It's more just being more entrepreneurial to try and look at other ways to get the security behind it.
So maybe on that note, that's really important to this whole piece, is to work through a default. Defaults are going to happen. We know it's going to happen. It happens at the banks, happens everywhere. What's the experience? Maybe give us an example of working through a default and or impairment.
Yeah, so we've been kind of fortunate so far in the sense that, we've been operating for the past 5 years, which has been a really good marketplace for lending in general. Because we attach ourselves to the senior part of the capital stack and are collateral based, it's not really, I shouldn't say it's not that easy, but it's pretty, we have to screw up pretty bad in order to take a really big impairment on our book. That being said, we definitely can. So thus far in our 4.5 years on a $400 million loan book right now, we've written off in less than $1 million total of deals. Currently, we have less than 3% of our book that's non-paying, as far as interest, but all 2 of the 3 are expected to come back online very soon. So it's not a very troubling situation we're seeing yet. But if you talk to a lot of people from our credit team that have been through a number of cycles, we're expecting impairment. It's not saying that we don't underwrite to try and pick a loan-to-value rate whereby through the next recession we don't think we're going to lose money. But could we be a little bit wrong? Could cost to unwind the position be a little bit more than we expected? Possibly. Could our 80% or 70% LTV end up being 65? Sure. It'd be pretty hard for us to take a massive impairment, though. Unless it's fraud.
Rob, we're going to have to cut you off here. I got one question for you, just to keep everyone on time. For the audience, what type of client would you say would be appropriate for the next stage private debt fund?
Yeah, so to me, I look at it in a few different ways. You know, a lot of money that comes to us is a replacement for, you know, from the traditional fixed income area. To me, it's, you know, this fund is not a substitute for government bonds or treasury bills, but anyone that's owning, say, any, you know, high yield bonds in their portfolio, any equities in their portfolio, these all become a decent, I don't think that's mine, right? No. These become a very, you know, a decent substitute for, you know, for those within a portfolio. So anyone willing to take that kind of risk, you know, whether they have any equities in their portfolio, any corporate bonds, or other alternative yield products, they definitely become a suitable candidate for.
Thanks, Rob.
Thank you.
Trying to keep everyone.
Thank you.